Hey folks, in this video, I just wanted to talk about the jobs report. I wanted to talk about the Fed funds rate, and I also wanted to talk about the SPY technicals. So I know I have a lot of new viewers, so I'm just going to start out my process from the beginning. So today, we got a lot of data drops from the jobs report. So the quickest way that I like to look at the overview of everything that happened today is to just go on investing.com and look at the economic calendar. So from here, I'm going to go on news. We're going to hit economic calendar and we're going to look at today's data. And by default, they give us all of these different countries, but I just care about America. So I'm just going to clear all of that and I'm going to hit United States. And then we're going to go ahead, apply that filter. So now I get all the economic data drops that happened today. So first thing we get is average hourly earnings. That is 5.2%. We were forecasting 5.3%. So, obviously if average hourly earnings is going up, then that's going to cause a lot of these corporations to pay people more money. So that's going to cut into their margins. And what they're going to do is they're likely going to increase prices. Now that's inflationary. So we want to see this number drop or at least go stagnant. So just keep that information in mind. Now we're going to click into this so that we could see some historical data here. So let's just go back a little bit more in time. And we can see, let's see, like right here, we saw a 5.7% increase. That was in February of 2022, reporting for January. So now we've been seeing 5.1, 5.6, 5.5, 5.2. So right here, it's going 5.2, 5.1, 5.2, 5.2. So this is starting to go a little bit stagnant. So this is somewhat good news, but ideally we want this to go down a little bit. Now, let's just go back to this economic calendar. And average weekly hours right here. So here, we're forecasting 34.6. We got 34.5. Now, this, I don't really think that this information is all that important unless we see a huge drop. So let's just say we go from 34.5 to like 34 or like 33.5. Well, then to me, what that means is that employers are essentially cutting down hours. And then, what usually happens when people's hours start getting cut? Well, what happens after is layoffs. So that's kind of what I would be looking for here. But, this information is generally pretty stagnant. It doesn't change a whole lot. So now let's go back. So now they talk about government payrolls, manufacturing payrolls, non-farm payrolls. We'll talk about all of this in this Excel spreadsheet that I have. So we'll talk about that a little bit later. But let's just take a look at this participation rate. So participation rate, it's all the people that are working or looking for jobs. So right now, we were expecting, I guess we were expecting something closer to the previous, so 62.1, but we came in at 62.4. So let's just take a look at the data from February, right before the pandemic. So I'm going to have to go down in history a little bit. So let's see, we're looking for February of 2022. So we're going to look at this March data for February. So here we saw labor force participation at 63.4%. Now what did we get? We got 62.4%, so it's 1% off. So that's just kind of the way that I look at it. So we're not seeing full participation from when we were in February of 2022. So we're still a little bit under that. So yeah, 1% off. But just look at how far we've come. So we were all the way down here, in the low 60s. Now we're back at 62.4. So, it's going up. And essentially, the reason why people look at this is, let's say this goes back to February, then what happens next? Then we could start seeing maybe like a downtick. So, or it goes stagnant. Now, let's look at one more thing. Let's see, what was it? The unemployment rate. So we were expecting 3.5, we got 3.7. So just like with the labor force participation, I'm going to go back in time. I want to look at February of 2020 data. All right, almost there. So here, we're going to look at March for February. This was 3.5%. So we actually got that last report for July. So we got 3.5. So now we're at 3.7%. So do keep that in mind. Now, the next thing we're going to look at is we're going to actually look at the non-farm payroll data. So to get all of this information, I go to bls.gov. Now, from this website, I'm going to go on economic release. I'm going to look at the monthly data. Now, I like to look at this right here, the employment situation. You go ahead, we're going to click on that. And then if we want to look at the non-farm payroll specifically, we're going to go to, let's see. We want to look at this one right here. Employment Situation Summary, Table B, Establishment Data, Seasonally Adjusted. So I basically got all of this information and I copied and pasted it into an Excel spreadsheet. So here's that spreadsheet. Now I went ahead and grabbed more data here from prior months because notice what they give us. What they give us is, what they give us is just these few months right here. They give us June, July, and August, but I want to look at more than that. So that's why I went ahead and put this in an Excel spreadsheet for you guys. So keep in mind that these are preliminary numbers. So they go ahead and they do adjustments. So they recently just did this adjustment on June and July data. So here I have the prior report. So if I'm looking at the prior report for June, they were saying 398,000 jobs and 528,000 jobs in July. So here in the current report, they revised that 398,000 to 293,000. Now the July number is pretty much the same. It didn't really change a whole lot. But here now we have this new data point. We have August. Now we got 315,000 jobs. So this is probably some welcoming news, but we were actually forecasting for 300,000. So overall, I personally think that this is welcoming news because look at this trend data, we were seeing 398,000, 368,000, 384,000. And then now with this revision, we see 293,000. So seeing 315,000 coming from 526,000 the prior month, I think that this is welcoming. Now, what would be even more welcoming is if we saw this number continue to go down in September and then in October. So, that would be welcoming news to me because essentially that would be telling the Fed, oh, hey, what we're doing is working. So maybe we could back off a little bit. And then eventually, maybe they could finally go and start cutting rates because we all know that the Fed is going to cut rates at some point in time. Is that going to be next year? Is it going to be the year after? Well, one thing I feel pretty sure about is that this is going to happen within 3 years because I don't think the economy can handle this type of high rates for an extended period of time. So let's just take a look at where we saw the jobs go down. Well, right here in construction, went from 24,000 jobs added to 16,000 in August. In retail trade, we saw this number go up. So we went from 29.1 thousand in July and then 44,000 in August. Transportation and warehousing, this number went down quite a bit. So, we can see a pretty strong growth right here, except for March. So now we're seeing 4.8. So it's actually dropped quite a bit. Now, here's the interesting thing. So, leisure and hospitality, this sector has been so hot. I mean, 138,000 jobs, 124,000, 104, 59,000, 68,000, 43,000, 95,000. Now we're seeing 31,000. So, this sector is slowing down just a wee bit here. Government. So, from the last jobs report, we saw a lot of government jobs being added. But for this report, we didn't see as much. Just saw 7,000 jobs added here. So with all of this data that just dropped, how did the Fed funds rate react? So let's go back right here. Now let's look at the CME Fed Watch tool. So now we're expecting the 75 basis point rate hike to be a 58% chance, whereas the 50 basis point rate hike to be a 42% chance. Well, what was that yesterday? Well, yesterday, September 1st, we were looking at a 75% chance that we were going to see a 75 basis point hike and a 25% chance that we were going to see a 50 basis point hike. So this number actually went down a little bit. So now let's go ahead. Let's look at the S&P 500 Spy ETF. So if we're looking at this right now, we're up slightly. So I do think that the market saw this as welcoming news, but I'm just looking at the technicals here now. So if I'm looking at the technicals, I like to look at the weekly chart. So I'm looking at the 5-year time frame. So on this 5-year time frame, every single candle represents 1 year. So there are some longer term trends that I see. Now, this first trend line, I'm connecting the tops right here. So I'm connecting this big top here in 2018. I'm also connecting this massive top here at 2020. And then you can see, we connect this top and that top. And then we do this pivot where now this becomes support. And then we have this massive rally. And then we come down and then you see this huge trap, this bull trap that we had where we broke underneath this support. Then now we got back above it, but now we're actually flirting with it. So we're right on that support. So let me just zoom in here to show you guys. We are smack dab on this support. So if we break underneath the support, well, what does that mean? Well, I essentially think that we could start seeing the bottoms again, Are we going to double bottom? Or are we going to build a higher low from this point right here? So, that's going to be an interesting thing to watch. Now, there is another trend line that I am looking at. So I'm looking at this trend line right here. So let me remove the moving averages so you guys can see it better. So you can see this trend line, it goes all the way back to 2016. We're catching this bottom, that bottom, that bottom. We're catching this consolidation move before we broke down below in 2018. And we're catching this support, and then you can see right here, we had this massive move where on the week we actually closed exactly right here on this trend line in 2020. And then when we started going below that, we saw this massive haircut down. And then you can see we rallied back up. We had this 1 week where we had this solid run above this trend line. And then the following week, we had this massive sell-off to reverse that move. And then we essentially closed right back on this trend line again. And then we started chopping around sideways right along this trend line. So this is a very important trend line, you guys. Now, let's just follow this trend line a little bit more. Well, it essentially basically caught this bottom right here. I mean, we're just like a hairline away from that. So if we start falling again, do I think that this trend line could catch it? Well, possibly. And if we do catch the move down with this trend line, that would be signaling something closer to like a double bottom right here. So that would be something along the lines of like 360, 370 maybe. So do keep in mind that as we move further in time, this trend line is going up. So time is actually probably on our side here. So one other thing that I'm looking at is I'm looking at 343 or 348.30. So let's just go ahead and introduce the moving averages again. And then when I'm looking right here, you know, this kind of lines up right with the 200-day weekly moving average. So this red line right here, as you guys can see, it also lines up with this former top that we made right here. So that is probably a big pivot point that I'm looking for, is for us to hit that 200 weekly moving average, which is sitting right at about 348. So overall, I hope you guys enjoyed this video and have a great one.